How fast can the Fed move now, and what does that speed mean for your portfolio? Today's big shift isn't the rate level, it's the playbook behind it. Fed Chair Kevin Warsh kept interest rates unchanged, but he unveiled a task force model that could compress the time from data to decision. For markets that price every hint on inflation, growth, and liquidity, the process change may matter more than a single meeting outcome. When process accelerates, pricing adjusts sooner. Here's the context. The Fed isn't rewriting its mandate. It's reorganizing how it analyzes and implements policy. Temporary goal-driven teams will pull in specialists from monetary analysis, supervision, payments, and market operations. The aim is simple: find trade-offs faster, spot plumbing bottlenecks earlier, and translate guidance into actual financial conditions with fewer delays. That has several implications you should watch. Communication leaned into risk management, not just point forecasts. Expect decisions that weigh asymmetric risks around inflation and growth, with resiliency getting more weight when uncertainty rises. Attention to the pipes, money markets, bank funding, payment rails, signals a tighter link between the policy rate, balance sheet choices, and what you feel in credit spreads and funding costs. And because the FOMC meets on a fixed schedule, parallel analysis could surface usable findings between meetings. That shortens the loop. Data releases can move expected policy paths in real time, not just at formal gatherings. Why this matters for assets? Faster aggregation of information can shave weeks off policy lags. If inflation deviates from the 2% goal or growth cools, the Fed may move or signal moves sooner. Stocks could see sharper swings around jobs and CPI prints, while prolonged periods of uncertainty could ease if guidance comes earlier. Bonds may react more quickly to shifts in front-end expectations. ETFs that bundle rates and credit risk could see tighter alignment to policy signals. Crypto-exposed assets, which trade liquidity and risk sentiment, may feel the ripple through funding conditions and dollar dynamics. Your practical takeaway: adapt your playbook to speed. Track not just headline rates, but the Fed's process signals, task force themes, implementation notes, and references to market plumbing. Watch money market spreads, bank funding indicators, and payment system stress as early tells. Tighten risk controls around key data days, refine hedges earlier, and expect sector leadership to rotate faster when policy expectations pivot. Want the deeper dive and the nuances by asset class? Read the full article at finlitica.com.